In the old days, the great example always was free dinner, learn about XYZ Securities, posted at a Holiday Inn.
Did Goldman give away free dinners?
I don't think so, but certainly in today's world, with the advent, obviously, of the internet and the media, social media, the issue of general solicitation really is a very difficult one.
And last year we did about 10 million, and this year we're planning on doing over 100 million.
Wow, $100 million in year 3?
It'll be year 3.
Year 3, wow. Well, congratulations. That's, that's obviously incredibly impressive. You know, Neil, one of the things when I heard that the company is from Boulder, I'm like, I can't believe there's another successful company in tiny Boulder, Colorado with, Brad Feld and Foundry and Seth Levine and, other companies. What's it like? I mean, it must be amazing to work in that little place with all of these successful companies. I got to tell you, it was a pleasure for me. You were one of the first guys that I had a meeting with, that I marketed to, talking about my Facebook thesis, and it was like I was preaching to the choir. Hey Mitchell, thanks a lot for joining us here today, being our first guest in our pilot show.
Thank you, Lou, my pleasure.
So can you give everybody a little bit of background on yourself, your firm,
Sure.
Your clients?
It'd be my pleasure. My name is Mitchell Littman. I'm a lawyer, been practicing for 27 years, 20 in my own shop, Littman Krooks. We're a boutique law firm based here in New York City. We specialize in corporate securities matters. We represent public companies, private companies, investment banking firms, broker-dealers, with a niche practice in the secondary market.
Okay, great. Now obviously we're all here because the market for these secondary shares has really just exploded over the last 6-12 months. You've been in this market for a long time. Can you talk about kind of how the market started and how it's evolved over the last few years?
Absolutely. I think to understand the market today, it's probably important to go back about 10 years ago. Following the dot-com implosion, what happened was you have a lot of investors that become leery of the IPO process. A lot of the smaller broker-dealers and investment banking firms that were taking out technology firms, frankly, did not survive. And of course, the SEC put out Sarbanes-Oxley, or otherwise known as SOX. The cost of becoming a public company became very prohibitive and very expensive. And as a result of which, it was very difficult, particularly for small technology companies, to conduct an initial public offering. In the last several years, you have a lot of technology companies that have been growing. They're all trying to find the same engineers and software guys, and how do I reward them? If I give them equity, there's no liquidity here. A few years ago, one of the things that the SEC did well was they took Rule 144 and they made some important changes to it. Most people think of Rule 144 as the ability to sell restricted shares in public companies. But there's a part of Rule 144 that says that if you're a non-reporting issuer, meaning a private company, and your stock has been held by a year by a non-affiliate, a regular employee, they have the ability to now sell those shares under the securities laws. Technology companies have now allowed their employees to take advantage of this rule, and thus the secondary market has developed.
And there you go. So from an investor standpoint, what are the kind of the 3 things that you think investors should look out for when they're looking to buy secondary shares?
Well, I think the secondary market, the biggest knock on the secondary market certainly is the lack of transparency. The biggest problem, of course, is by definition you're buying securities in private companies. They have no obligation to give out financial information, current events like a public company. So you have no direct basis of knowledge of the issuer, its prospects, or its business. And I think that's something that needs to be taken into consideration. The second issue, of course, is lack of liquidity. While these technology companies generally allowing their employees to sell, it's a one-time transfer. In your hands, generally speaking, until there's a liquidity event, meaning the company is either sold or goes public, you're not going to have the ability to get any liquidity. And the third unfortunate issue is what I call due diligence. The bad guys, the hucksters, they follow all the trends in the market, and you've got to do your diligence to make sure that you're dealing with a reputable source to make sure that you are buying Facebook shares or you're buying Twitter shares. So deal with a broker-dealer or another source that you have confidence in that has some integrity in this market.
So, one of the interesting things to me is as this market has evolved, and there seems to be a lot of gray area, such that even a firm, as smart as Goldman Sachs has started to get involved and misstep. Can you speak at all to kind of what happened with Goldman Sachs and the selling of the Facebook shares?
I was not involved in that transaction, so obviously I'm just, I've read what you have read as well. And it seems that there's really been 2 issues there. One is that unlike the secondary market, which is a transfer from shareholder A to shareholder B, the Facebook transaction with Goldman Sachs was actually a private placement by Facebook of securities. And to have a good private placement, the bedrock of the private placement exemption is no general solicitation. If you have general solicitation, you're kind of prepping the market. The SEC will look at that as if you're conducting a public offering.
Can you just help explain to everybody what is general solicitation?
Well, it's a good question. General solicitation is a manner in which you are going out and finding investors through means of publicity. In theory, you're supposed to have what is known as a pre-existing substantive relationship with your client in order to invest in securities. So if you're going out and you're using general means of attracting those investors, that's deemed a general solicitation. Now, in the old days, the great example always was free dinner, learn about XYZ securities, posted at a Holiday Inn.
Did Goldman give away free dinners?
I don't think so, but certainly in today's world, with the advent, obviously, of the internet and the media, social media, excuse me, the issue of general solicitation really is a very difficult one. From what I read, it seemed that Goldman did everything right. They made their clients sign confidentiality agreements, and as I understand it, they actually hand-delivered the offering materials to the investors. Needless to say, the information leaked out to the press, and there was just so much publicity about it that they felt this was not a fight they wanted to have with the SEC.
And there you go. So, so much gray area, things moving so fast here. As you look out into 2011, 2012, you look out, what do you think is going to, are the rules going to change at all to kind of accommodate how the market has changed? What do you see for the future of the market?
Well, I think there's a few things that are certainly on the table. One other aspect of the Goldman transaction, of course, was the use of the special purpose entity to buy securities in the issuer. Now, I think SBEs and SPVs, or whatever acronyms you like, has unfortunately taken on a bad tenor as a result of Enron. But basically what these are partnerships that are formed for the purposes of investing in these companies. Mm-hmm. By rule, the SEC has announced that if you have 500 shareholders of record and $10 million of assets, you are required to file periodic reports with the SEC. You're a public company. It's a somewhat arbitrarily picked number, but that is the size where they feel that you are so robust, shareholders are entitled to that information. Generally speaking, the SEC has put out guidance that for purposes of record, any entity, you don't look through it, it's only one shareholder. But I think there's been a fair amount of criticism of that, and that is something that the SEC will take a look at to make sure that issuers in particular are not looking to circumvent the rule. So that's issue number one. Issue number two, remember the SEC's mantra is that they are the investor's advocate. They are looking out for the proverbial widows and orphans, of course, to making sure that their investments are sound. And I think that the lack of transparency is something that affects the regulators and is something they're going to take a look at. And finally, the general solicitation issue. This one, frankly, to me, is one that goes even to a matter of public policy. If you look at Facebook, as you mentioned earlier, we now have a situation where the SEC shut that down in the U.S. Foreign investors are investing in probably the most important company in the last 10 years. From a public policy point of view, that's something that I think we all need to think about.
Oh, wow, all interesting stuff. Thanks again for coming here, being our first guest.
Absolutely.
And we look forward to having you back for the 100th show.
My pleasure. Thank you very much.
Thanks a lot, Mitch. Hi,